Welcome back to Simply Money. Today we're going to look at a scenario. If you had invested $1,000 into SCHD back in January of 2012, so as the time of this video recording, you're looking at about 12 and a half years. That initial $1,000 investment and a $250 biweekly contribution, you would have come to a point now where you would be at $171,561. That's over 12 and a half years with a $250 biweekly or $500 a month investment. Let's look at the chart real quick. The reason I want to show you this isn't so you'll go out and buy SCHD. This is just an ETF that I chose because it's very popular and a lot of people are talking about it. To show you that even SCHD, which has had some ups and downs, it's had a rough stretch over the last few years, it has still performed really well. The key to success in investing isn't necessarily picking the home runs, isn't picking the diamond in the rough, finding the Amazon at IPO or finding Nvidia before it takes off. Those are great. And if you find something like that, that's awesome. And you're going to do really well. But the odds of you picking the right stock and holding it till the right time and not selling it before it starts to go down, or whatever the case might be, is very slim. That's why I encourage people to invest in index funds, ETFs, to diversify your investment and not have to worry so much. Yes, you won't hit the home run, but you'll have that steady, consistent growth over long term. And that's how you become wealthy. That's how you become financially independent. So this is to show you not to jump out of the stock market when things go down. A lot of people would pull their money out of SCHD in 2020 or any stock because of COVID, or during the 2022 recession as inflation started hitting and the stock market started going down. But look at the recovery that we've been having. Now there's talk again of a new recession. Things are going to crash. There's a bubble. Maybe there is. Maybe the stocks will dip really hard, but they will recover. They always do. And if you're diversified, you will be safe. Check out the video I have above on how to diversify, understanding the stock market and what index funds are and how you can make sure that you're diversified not only in various companies, but various sectors, and to understand that before you start investing. Here's the chart. $1,000 invested in January 2012. With a $250 contribution biweekly. You would have contributed $82,750. That's a lot of contribution over 12 years. But that's what steady, consistent contributions will do. They add up. And if you're just putting that money into a bank, into a CD, you would grow that slightly. You might be able to keep up with inflation. You may not. But you would end up basically with that $82,000, give or take a few dollars, with a safe, easy investment, the secure way of going. But when you diversify and you invest for long term in the stock market, using SCHD as an example here, you can see that your capital gains, the growth of the SCHD index, has grown and added $62,750. You can see this right here. This is the portion of that total that is the gain of the stock price. And then you also have $26,000 that you've received in dividends that have been reinvested back into that, buying you more shares. So let's go down here. This great tool, stowcalculator.com. You can get this free. It's a great tool just to look back a few years and how certain stocks, ETFs, index funds have performed and how it breaks down in various aspects. So we can go here, you can see your profit and your capital gains. So your total profit with capital gains and dividends is $88,000. So you basically doubled your contribution of what you've put in. You can see here that over that 12 years, you've received $26,000 in dividends. It's been distributed 50 times for an average of $521. Again, if you don't understand dividends, check out this video here on what dividends are, how they work, and the snowball impact they have. Because this $521 includes the first dividend payment back when you only had $1,000 invested and were investing $250. So by March of 2012, you probably had $4,000 invested, your dividend was probably a few dollars. Now with $171, your dividend is going to be very large, several $100s each quarter, and it's only growing as you continue to hold and reinvest into this ETF. You can see your total shares that you've accumulated by your biweekly contribution and your dividend reinvestment. You're up to 1,788 shares. It's a current price of $81.35 in purchase price of $26.42. The duration, as you can see, has been 12 years, 6 months, 16 days, again, as of this filming. And annual return has been 6%, but your total return has been 107%. Go down a little further here. Again, this breaks down your total contribution, your contribution shares, and your average price. The current price is $81.35, but you've paid on average $51 for all of your shares. That's dollar cost averaging. Even though you're paying $81 for each share you own now, when you first purchased in 2012, you were only paying $26. You've averaged buying these over the last 12 years at $51. You can see that breakdown. Here's how you go in. You just put in the stock you want, the amount you want to invest, the start date to evaluate and calculate from, reinvest dividends. Oh, look at that. I forgot to click reinvest dividends. So we're going to redo this and look what changes. Again, we're still contributing the $250 biweekly. Let's calculate this. There we go. That's a little better. You can see because before we did not do the reinvestment of the dividends, we received $26,000. That's my mistake on putting that in and not hitting that toggle, the reinvest dividends. On this scenario, the dividends are being reinvested. You can see your capital gain is right here in reinvested shares value, but your total value, you can see how much it went up, about $15,000 extra because those dividends were reinvesting and buying more shares. Let's go down and see the difference here from what we had just looked at. Your total profit's 104 versus the 88,000. Your capital gains, and then you have your dividend average. See how it's gone up because you were buying more shares with those dividends reinvesting. So you've received $30,000 in dividends, but you actually reinvested those. The other scenario that I accidentally did was $26,000 that you did not reinvest. You would have been able to take that out. It would have been sent to you, and you could have spent that, used it for whatever. But I encourage you to reinvest your dividends until you're ready to begin to withdraw from these portfolios. Before we had 1,700 shares. Because you're reinvesting those dividends, you have almost 2,300 shares. You've got 600 more shares from those dividends buying more shares. It's a great way. That's the compounding impact. I'm glad that I made that mistake to show you the difference here. You can see the annual return increased, your total return increased. And so let's go down here to the summary. Total contribution, still 81,000. Contribution shares, that's how many shares you bought from your contributions. But you can see the number of shares you own because the dividends were buying more shares each quarter. Those 50 payments, they would buy however many shares that dividend would afford you to buy. And then you build and build, and that snowball kicks in. And again, the average price is $51.81 that you've paid. So you can see what would happen if you had invested $1,000 in SCHD in January of 2012, added $250 biweekly, you'd have $186,000 and growing. Look at this video here, and it breaks down SCHD and each quarter and the dividend amount and how much you would have earned. It's a different scenario, but shows you the growth and the compounding of that. It's a step-by-step on dividend growth. Thank you for joining me on Simply Money. I hope you enjoy these videos with demonstrations and examples. Hit the like button and subscribe if you would. It helps me continue to produce these videos. And we'll see you next time on Simply Money.